Welcome to the fifth episode of Fundamentals, a platform to understand your fund tenet. Here we bring to you the minds behind the fund in which you would have invested in. Today, for a change, we are not discussing a fund, but a category: target maturity passive funds in fixed income. Now, fixed income is considered to be a very boring category, and passive investing is more dull. But it's rare that we see a new category garnering such a huge AUM in such a short period of time without any major distribution incentive or a push. This category has been pioneered in India by Edelweiss Mutual Fund, starting with their Bharat Bond series less than 3 years back in Jan 2020. Today we have with us Mr. Dhawal Dalal, who manages all the five Bharat Bond series and three SDL PSU index fund for Edelweiss. Hi Dhawal, many thanks for joining in and
It's
making
my
our
pleasure.
viewer aware about this category.
Yeah, thank you for inviting me.
So Dhawal, to start with, for the beginners, what is a target maturity fund and how is it different from, let's say, a FMP or conventional fixed income funds?
Yeah, so Harsh, as you know that most of the investors know a conventional fixed income funds, right? These funds are run for perpetuity. That means an investor can get in and remain invested for as long as they want, right? And they can redeem the money whenever they want the money to be back. Unlike those conventional funds, the target maturity funds come with a specific maturity date. That means the money that investors have invested, no matter what point of time they have invested, on the maturity date, the money is returned to the investor and the fund is closed. So from that perspective, the target maturity fund are similar to fixed maturity funds, but they are different to the conventional fixed income funds, which, as I mentioned, to run for perpetuity. The other important factor to keep in mind is that just because there is a maturity date, and most of the investments are made to ensure that they are mature on or before the maturity date of the target maturity fund, there is a predictability of returns for clients. And this is something that has attracted a lot of attention of the investors, because unlike the conventional fixed income funds, where investor invests for either 1 year, 2 year, 3 year, 4 year, 5 year, there is no surety or predictability of return. Or that as it at the time of investment, what kind of return they will make if they remain invested for say 1 year or 2 year or 5 year. And comparison to that, the target maturity funds offer that kind of some kind of predictability of returns, and that has attracted a lot of investors in the attention to this kind of funds. The other important point to keep in mind is that in a target maturity funds, there's a lot of discipline, investment discipline, and that is that the funds are able to tell you what kind of credit rating that they are going to invest in, what kind of asset class that they are going to invest in. So from that perspective, there is some amount of comfort in the investor's mind that what kind of investment portfolio that am I going to be able to see that is going to mature on or before the target maturity date of the portfolio. So unlike the normal traditional fixed income funds, where there is a variation in credit rating or the type of the instruments, the target maturity funds are a little bit more structured.
Got it. So you're saying predictability of return and consistency of portfolio is something which differentiated from conventional fixed income mutual fund. Now that we have understood
maturity date
and maturity date also.
Yeah.
Now, we have understood target maturity from your previous answer, but still our viewers are not very well versed with index investing in fixed income category. They do understand a bit of index investing in equities, but not in fixed income. So if you could please help our viewers understand that as well.
So target maturity funds are normally two types of target maturity fund. I'm talking about from a fixed income funds perspective, right? So in India, we have exchange traded funds, or which is called target maturity bond ETF. which is like, as you mentioned, the Bharat Bond ETF series, are the target maturity bond ETF series, right? And the other type of funds are called target maturity index fund series, in which we have launched Edelweiss under our private label SDL plus PSU index funds. We have three index funds in these categories. Now, on the operational front, they are all similarly managed. Okay, so the fund management style is identical, both in case of target maturity bond ETF as well as target maturity bond index funds. There is an underlying index and there is a maturity date that the portfolio is trying to follow or replicate, right? The only difference is that the ETFs, as the name suggests, they trade on the exchange, right? So any potential investor looking to invest will have to buy those units on the stock exchanges. And if they wish to sell, they have to sell those units on the stock exchanges. So the bulk of the transaction, I'm talking about from a retail investor's perspective, okay? Bulk of the transaction and activity is concentrated on the stock exchanges. Now, whenever when you're buying and selling on the stock exchange during the time of the period, right? There is a price variation. That means at 10 o'clock, the price is different, and at 11 o'clock and 12 o'clock, and just like every other stock which trade during the course of the day. As a result of that, the investors will have to pay attention to the prices that are available on the screen during the course of the day. Unlike the index fund, which normally run like a mutual fund. That means investors will have to approach for buying and selling, will have to approach the AMC directly, right? And regardless of whether the investor approach the AMC at 10 o'clock or 11 o'clock, so long as their investments are received before the cutoff, everyone gets the investment at the same NAV, right? So to that extent, there's a difference. So on the target maturity bond ETF, bulk of the transactions are taking place on the exchanges, and they are either trading at a premium or a discount to the underlying NAV, and there's a variation in the price. So to that extent, the liquidity risk it sits with the investors because they buy sell directly between two investors. In case of target maturity index funds, because they're directly dealing with the AMC, just like normal traditional fixed income fund, the liquidity risk remains with the AMC. But all investors get the same NAV for the subscription as well as redemption.
So that brings me to the next question, which I wanted to check with you. So you have both the options, like you mentioned, and you also mentioned the features of both of these. So does that mean that as a thumb rule, a retail investor should primarily go for index funds and not ETFs if there is the same underlying available?
See, generally, in my view, retail investors are also very well versed with the way equity markets operate, right? Now, generally, there are no options like in same category, you have ETF as well as index fund also. It's generally either or. Like in case of Bharat Bond ETF, we have maturities where our index funds are generally not available. That said, I think investors will find some amount of trading opportunity if they invest through ETF on the stock exchanges. But if they are looking to invest in target maturity fund as part of their long-term fixed income allocation, in my view, I think index funds will suit their purpose as well. The other important point to keep in mind is the expense ratio. In general, ETFs are slightly cheaper because there is no intermediary in between. Whereas in case of index fund, there are intermediaries who are trying to offer these products to their clientele. And as a result of that, there is a marginally higher expense ratio to keep in mind. The other important point to keep in mind is that in the ETF, there are no outflows in form of dividend. Okay, so it's only price appreciation that investors will get over a period of time. Whereas in the index fund, depending on the option that you are in, there's a potential dividend option available for you in case if you wish periodic cash requirement. So these are the two important issues that people will have to keep in mind while selecting either an ETF or an index fund.
Got a point. So if you are saying that if the time horizon is a little longer, and if you are inclined to take a dividend from your fund, then you might look at index fund, provided you are okay with minuscule increase in the expense ratio in the underlying.
Yes.
Now, Dhawal, since you manage ETFs, there are a couple of terms which are associated with ETF whenever we analyze, whenever our investors analyze, which is like tracking difference, tracking error. So, A, if you could help us understand what are those terms, and B, if you could let us know how have been these for your funds.
Yeah, so these are relatively new terms that investors have to understand in order to make a decision how they should invest in which kind of funds. So a tracking error refers to the volatility of return vis-a-vis the of the fund vis-a-vis the return of the index. So let's just understand very clearly in terms of a very small example, right? Suppose in a week, the index returns 1% each day. 1% on Monday, 1% on Tuesday, 1% on Wednesday, 1% on Thursday, and 1% on Friday. That means index is up 1% each day, 5% in a week, right? Now, as compared to that, if the portfolio is up 0.5% each day, that means 0.5%, 0.5%, 0.5%, 0.5%, 0.5%. That means it's up 2.5%. Through the week, right? In that situation, because the gradient of index and the gradient of the portfolio is identical for this small example, the tracking error is 0. Okay, because whereas the tracking difference, because index generated 5% return in a week, but your portfolio generated only 2.5% return in a week, then the tracking difference is 5 minus 2.5 is 2.5%. Now, that's a simple way of explaining to you how the tracking error and tracking difference works. Now, again, in the same example, assuming for 1% each day and 5% through the week, if my portfolio had generated a return like first day 0, second day 2%, third day 1%, fourth day 1%, and 5 day 1%. So that's how it's generated 5% kind of return. In that situation, because the return of the index and the return of the portfolio is identical, the tracking difference is 0. But the tracking error is going to be higher because there is a difference in the delivery of returns in those 5-day periods. So the tracking error is basically the way how the ETF returns are mirroring the index returns. If the ETF returns are mirroring the index return in lock, stop, and barrel, then the tracking error is lower. If there is a volatility in the return between the index and the ETF, then the tracking error is higher. And the tracking difference is simply arithmetic difference between the index return and the portfolio return. So I hope I was able to explain.
Yeah, so I'll just summarize what you mentioned and maybe you can correct me if I'm wrong. So you're saying if the lines of return of the fund and the benchmark, they are parallel to each other or they are overlapping each other, then in that case, the tracking error is 0. But tracking difference could be in the time frame that you're looking at, what is the return which the benchmark has given, whatever is the return fund has given, subtract that and you get tracking difference.
Correct.
Perfect. So, Dhawal, you manage a huge AUM of 58,000 crore in this category. And this is huge if we ignore the liquid category in the fixed income space. Now, how do you ensure that your cash drag, impact cost, and liquidity is well maintained?
Well, see, ever since we have launched the funds, we have been fortunate that we have seen only net inflows in this category, right? And given the investors' enthusiasm towards this product, month after month, this category has received net inflows. So from that perspective, so far, our focus has primarily been to deploy the cash that we collect in suitable assets. So from that perspective, we have so far been able to see only how we should get invested. And every time we get inflows, our objective is to find suitable assets either from the primary market or secondary market. And given the fact that all these Bharat bond ETFs are only invested in AAA rated CPSE bonds, we have to continuously seek similar kind of assets from the secondary market. If we are not able to buy those assets, then we generally invest in government bonds of similar maturity, maturing on or before the maturity date of the underlying Bharat bond ETF. But as a measure of practice, we normally don't take cash call. Our objective is to get fully invested in the portfolio at the end of the day. So from that perspective, so far, we haven't been able to find any difficulties in deploying our portfolio.
Got your point. So Dhawal, this category is less than 3 years old, and still you have been
Yes.
able to get close to 60,000 crore in this, which is huge. Now, when we look at this kind of an AUM, the impression which we get is that maybe there are large institutions who are participating in this, because of which the AUM is on the higher side. Do you see retail participation also coming in this, or it's primarily institutional led?
No, in fact, initially it was in institutionals, but now I think the way benefits of target maturity bond ETF and index funds have been understood. As I mentioned to you, the predictability of return is one of them. The underlying portfolio and the quality and the lower expense are some of the other benefits. And the most important thing, given the level of inflation in the system that we have seen since the target maturity funds have been introduced, the tax adjusted returns have become very attractive. And as a result of that, a number of high net worth individuals as well as family offices are looking at target maturity bond ETF and index funds as substitution for their tax-free bonds. And as a result of that, we have seen very high level of interest from not only from the institutions, but as I mentioned to you about from high net worth individuals as well as family offices in this type of fund categories. And we are also now gradually seeing a lot of retail investors also looking at this category for the long-term fixed income allocation, particularly in the last 1 year post-pandemic, where the deposit rates have collapsed in the post-pandemic monetary policy, right? And in that situation, and the yield curve was very steep. And as a result of that, I think a lot of retail investors were attracted to target maturity bond ETF and index funds for their long-term fixed income allocation.
Got it. So Dhaval, in your first question, you mentioned about a target date for these funds. Now, if we look at your product suite, you have funds maturing starting 2023, going till 2032. Now, the question is, how should an investor decide which fund he or she opt for, other than the indexation aspect? So should one link it to the maturity requirement and basis that plan duration, or are there certain other variables which one should keep in mind?
Yeah. So I think the first starting point is that the benefit of these products are fully utilized when the investors remain invested till the maturity of the product. Okay. So from that perspective, I think the first thing investor will have to do is that they will have to figure out what is their investment horizon while before investing, right? We normally recommend investors to first identify whether they wish to invest for 3 years, 5 years, or 10 years. And based on their comfort, they will have to choose a suitable target maturity bond ETF or an index fund that matches their investment horizon. If investors are looking for a only 3-year kind of investment, we normally don't suggest them to invest in the 10-year product and sell after 7 years, because that will probably expose them to the vagaries of the underlying movement in the bond market, right? So that's why investors should always first identify how long do they wish to remain invested in this kind of product, and then take a decision on whether they can find a suitable target maturity bond ETF or index funds who has the underlying portfolio which gives them comfort in terms of credit quality and other parameters.
So Dhaval, you mentioned about not taking an exposure in the longer duration than what one is intending for. Now that brings me to another question, that what are the risks in this category? Because till now we have discussed only the benefits of this. So there must be certain risks also in this category. So what are those?
See, as I was telling you, that the beauty of this product is that it has a target maturity date. That means you have bond-like or fixed deposit-like experience. The underlying portfolio credit quality is also very well known in advance, so that investors know what they are getting into, right? The portfolio transparency is also very high, particularly from our perspective, where we put our entire portfolio on their website for investors to see, and all the critical parameters like portfolio size, portfolio YTM, modified duration, everything is in a transparency. So transparency is very high, and the expense ratios are very less. That means money saved is money earned. Now, from that perspective, I think there is a very high level of comfort that investors have with this kind of product. And given the fact that bulk of the transactions particularly at Edelweiss AMC are in the form of AAA rated CPSEs and sovereign bonds, the credit quality risk is very low. So from if the investors are remaining invested till the maturity of this product, so from that perspective, they will have a very smooth investment experience. The only risk in this kind of product is that if there is a portfolio downgrade or a credit downgrade in a portfolio, right? Then as per the SEBI regulation, we will have to sell this the underlying downgraded bond in a particular time frame, and then reinvest the proceeds in a new bond. So that is something that will probably have some amount of destabilizing impact on the predictability of return. This is the only risk that we will have to keep in mind. And that's why I think in order to mitigate this kind of risk, we only invest in high quality AAA rated and sovereign bonds.
And the risk of any downgrade in CPSC or SDL seems to be negligible, because otherwise there'll be a lot of questions on the fabric of financial institutions in India. So that was my next.
SDLs are, as you know, sovereign risk. So normally they have very little risk of getting downgraded. Within the CPSEs, we normally tend to focus on those CPSEs which are strategically important for the government of India. And we believe that those strategically important CPSEs will have a lower risk of downgrade from a credit perspective.
Got it. So Dhawal, since this is a fairly new category, how should an investor assess the return of this category versus risk in different market cycles, especially in the context of rising interest rate scenario and falling interest rate scenario?
So just to be honest, this category works very well in a rising interest rate scenario. Okay, because as the portfolio YTM goes higher, right? Because of the predictability of returns, investors also get to know that now they will be able to earn better return if they keep investing more and more money, and when the yields are on a higher side. So in my view, in fact, this is probably one of a very few products out there, in the particular from a fixed income stable, which will provide better returns or opportunity for investors in a rising interest rate scenario. In the falling interest rate scenario, obviously there will be price appreciation. But in that situation, given the fact that this kind of product, because of the target maturity date, there is a consistent decline in the average maturity of the product. In a falling interest rate scenario, I think investors will have to figure out which is the longest duration target maturity product that they can invest in order to benefit from the potential price appreciation during a falling interest rate scenario. But as I mentioned to you, that investors should always stick to a product which matches their investment horizon. And from that perspective, it may or may not be able to provide the price appreciation which come with the falling interest rate scenario. So that's the only difference that investors will have to be content with. But in my view, whether it's interest rates are going higher or interest rates are going lower, index funds, target maturity bond, ETF, and index funds are agnostic of any interest rate cycle. It will provide similar kind of benefits to the investors. But as I told you, it works very well when the interest rate cycle is moving higher.
Got your point. So what I understood is that if an investor is happy with the intended YTM, what one is supposed to get till maturity, then it doesn't matter whether the rates are rising or rates are falling. So Dhawal, that brings us to the last question. And we know you as the CIO, fixed income, Edelweiss. we have heard you, we have seen you, but there must be a team of people who would be assisting you, who would be helping you in managing this category. So if you could let us know the people behind the scenes, we can
Yes,
understand this further better.
absolutely. I think we at Edelweiss AMC, we are a 4-member team. I am the CIO, but the bulk of the current work is being done by my investment team, which comprises 2-member fund managers, and we have a dedicated fixed income dealer as well, who will execute transaction for depending on what kind of funds and what kind of assets that are needed to be sourced. Apart from the investment team, we are being supported by our risk management team, as well as the operations team, who are helping us in looking at various kind of risk in the portfolio vis-a-vis the index, as well as the operations team, whose job is to settle the transaction and report all kind of cash flows and other stuff. So it's a very operations intensive product and offering. Having said that, the beauty of this product is that given the fact that all the portfolios are passively managed, right, vis-a-vis index, there is no a star fund manager culture which is required in this kind of category, which in my view serves very well for investors and the partners, because it's a fund manager agnostic category. And this is something which is operationally intensive, but fund manager agnostic. And so from our perspective, I think we'll prefer to be on the backstage, but working very hard for our investors to ensure that all the transactions are done in an efficient manner. As I mentioned to you, that whenever we get the money, we have to immediately start getting invested. And whenever there is a redemption, we have to immediately start selling assets. So it's an operations intensive category, but not dependent on any active call taken by any fund manager. So from that perspective, we wish to keep our heads down and work continuously for the benefit of our investors.
Understood. So it is fund manager agnostic, it is interest rate cycle agnostic. So that makes a lot of sense for our investors. So Dhawal, that brings us to the end of this conversation, and it was really enlightening on a lot of factors, because this is the first podcast we are doing on fixed income, and that too on passive side of fixed income. And I'm sure our investors would really appreciate and learn a lot from this. Thank you so much for
Absolutely.
taking out time on a busy
Yeah,
day.
it
Thanks.
was my pleasure. Thank you for connecting with us. Thank you.